This is a demonstration of exercise 2223B, change from equity to fair value. Ecolab Inc. was a 40% owner of Quiet Inc., holding 800,000 shares of Quiet's common stock on December 31st, 2019. The investment account had the following entries, and the problem gives us a T account for the investment in Quiet, showing the original investment, debits for the percentage ownership in Quiet's net income, and credits for the dividends that were received using the equity method of accounting. So at December 31st, 2019, the balance in the investment account was $8,860,000. The problem goes on to state that on January 1st, 2020, Ecolab sold 500,000 shares of Quiet for $7,500,000, thereby losing its significant influence. And then the problem goes on to give the information on Quiet's net income and the dividends that were received from Quiet by Ecolab in 2020. The problem states that at December 31st, 2020, the fair value of Quiet shares held by Ecolab is $3,525,000. In the instructions in Part A, it states what effect does the January 1st, 2020 transaction have upon Ecolab's accounting treatment for its investment in Quiet. So in the beginning, the Ecolab was a 40% owner of Quiet and used the equity method. However, when it sold 500,000 shares of Quiet, its percentage ownership dropped to 15%. We can calculate that because we know they owned originally 800,000 shares and they sold 500,000, so they have 300,000 shares remaining. Quiet had an original or has 2 million shares outstanding. We can determine that by taking the 800,000 shares divided by the 40% ownership. So 300,000 shares divided by 2 million is 15%. So we know that after that occurred, they would now be using the fair value method to account for the investment. Ecolab is not required to use retrospective treatment when they change from the equity method to the fair value method. They just pick up with the balance in the investment account and then begin to use that to compare to the market value. So the first thing in Part B, it states compute the carrying amount in Quiet as of December 31st, 2020. So we have to compute first what the credit would be for the sale of the 500,000 shares. The balance in the investment account at that time was $8,860,000. We multiply that by the number of shares sold, 500,000, and divide by the total number of shares owned of 800,000, and we get an amount of $5,537,500, and that would be credited to the investment account. The next thing the problem states is that we have received dividends of $310,000 from Quiet. When we change from the equity method to the fair value method, we are required to track our dividends and our percentage ownership in the investee's net income to determine if we have received any excess dividends that we consider to be liquidating dividends that we're required to reduce the investment account by. So the problem gave us Quiet's net income for 2020 of $1,600,000. We are now a 15% owner in Quiet, so 15% of $1,600,000 is $240,000. So we're going to compare the dividends that we received, $310,000, with our percentage ownership in Quiet's net income, which was $240,000, and we see that we did receive an excess dividend of $70,000, and that would be considered to be a liquidating dividend. So when we receive the dividends, we would credit cash for $310,000. We would credit the investment account or investment in equity securities for the $70,000, and we would credit dividend revenue for the $240,000. So we would need to show that in our T account by crediting the investment account for the $70,000. Our balance in the investment account then at December 31st, 2020 is $3,252,500. The C portion of the problem states prepare the adjusting entry on December 31st, 2020, applying the fair value method to Ecolab's long-term investment in quiet securities. So the fair value as given in the problem for the securities is $3,525,000. The balance in the investment account at December 31st, 2020 is $3,252,500. So we would need to record the fair value adjustment by debiting fair value adjustment equity securities for $272,500 and crediting unrealized holding gain or loss income for the same amount. And that is the conclusion of the demonstration for exercise 2223B.